And before we get to the panel and get involved in some Q&A, I thought it might be a good idea to run through sort of the state of affairs or disarray in U.S. financials. A lot of U.S. financials will be coming your way to the distressed world in the not-too-distant future before dawn breaks and things begin to improve. Depending on the company, all parts of the capital structure provide opportunity and risk. There's a whole array of capital structure elements to financial institutions, running from common stocks all the way up to sort of deposit or in the case of insurance company, liability level assets which can be had. And they have all sorts of nuances and seniority levels between them. A lot of the risk is derived from CDS, and as I'll explain, CDS is just part of the problem that faces the U.S. financial institutions. Today there's a very interesting op-ed article in the Wall Street Journal by David Roche, who's a very well-regarded independent economist and strategist. The opening paragraph reads, as bank shares plunge to new lows around the world, it seems that we've entered the next stage of the financial crisis, most likely the last chapter in this horror story. The final word will probably be nationalization of major financial institutions in the United States and the United Kingdom and in many other companies. And I would generally say that that's pretty accurate, but I think you need to be careful about what you mean by nationalization. And why is that? It's because of CDS and other derivative instruments. If you nationalize a huge bank, and sort of when people nationalize banks, generally what they do is they take a bank or a financial institution into receivership or into conservatorship. If you take a major U.S. bank into receivership, and I won't mention any names, but you know who they are. If you take a major bank into receivership, that is a triggering event for credit default swaps. And if we thought the Lehman situation was bad, Jeff, one of these other major banks would be magnitudes larger than that. It would create just a whole host of problems across all elements of risk management in the global financial services industry. And I think that that's something which regulators are going to try and avoid at any cost.
So what you're saying is if nationalization or something like that comes about, they may well try and structure it differently, just in an effort to avoid a CDS sort of blow up or meltdown, however you want to characterize it.
I certainly hope they will. And
well,
I think
they didn't last time.
No, they didn't last time. I think that was a little bit of an experiment that we had, and it was an experiment that went awry.
Yeah.
Kind of like the movie The Fly, where the guy gets mixed up with the fly genes.
You know, I'm still trying to catch up on what you meant by standard deviation, but the point that you're making about avoiding this meltdown, people should understand is being said from the perspective of an institution that writes the insurance,
yep,
as opposed to the institutions that bought the insurance. You know, the metaphor is, you know, you paid your money into an insurance company to pay for health insurance, and they're all hoping you don't get sick enough to need it. Your institution made tons of money writing credit default swaps, but now you're hoping not to pay on it. I mean, I understand, you know, is that where standard deviations?
Yeah, no, we're actually both ways though. We're a market maker, so we write credit default swaps, and we also buy credit default swap protection.
What's the
from
dealer
others.
concentration of CDS? I don't know if you're going to get to that later, but I mean, is it sort of top 5 represent 80% of the trading in CDS?
I'm not sure I've got that number, but what I would say is that in terms of where the exposure is, I think that about 30% of that exposure is in hedge funds, and 70% would be spread elsewhere through financial services, which would mainly be the broker dealers, banks, things of that nature.